US President Donald Trump has announced a 25% tariff on all car and light truck imports into the country.
We were restricted from selling cars into the European Union, which is not nice.
The car market is about to crash.
The entire car market is so cooked. Every automaker on the planet is panicking.
U.S. car imports plunged nearly 20%. It wasn't a global slowdown. It wasn't consumer demand. It was one move from Washington, a sweeping auto tariff imposed in April that slapped a 25% tax on all foreign-made vehicles and parts. The goal was to bring manufacturing back home. But the fallout. It hit faster than anyone expected. Within weeks, chaos unfolded at American ports. Over 37,000 European vehicles, mostly Audis and Volkswagens, were stranded, stuck in holding zones from Baltimore to Houston. These weren't luxury excess. They were standard inventory models like the Audi Q5 and VW Tiguan, the backbone of middle-class car buying. But the companies didn't fight back with press conferences or flashy headlines. They just froze shipments quietly. The message was clear: the costs were too high, and the risk wasn't worth it. For everyday Americans, the damage landed fast. New car prices jumped by thousands overnight. According to The Guardian and Reuters USAs, auto sales are expected to drop by at least 1.8 million units in 2025, not because people don't want cars, but because they simply can't afford them. Entry-level sedans and compact SUVs, the kind families rely on, have become harder to find and even harder to justify. By mid-2025, what started as a ripple in trade policy had become a full-on tremor in the auto market. Inventory shortages, price spikes, and dealership shutdowns weren't the warning signs, they were the first consequences. The American car market isn't just struggling, it's breaking. And it didn't happen because factories left. It happened because policy told them they weren't welcome anymore. The rest of the world is moving fast. Mexico, Canada, South Korea, and Germany are already rewriting the rules of auto supply. Meanwhile, the US finds itself boxed in by its own tariffs, unable to import at scale, and not yet ready to produce at home. This isn't the comeback story leaders promised. It's a quiet collapse rolling out one shipment at a time.
More than 4 years, the Automaker CEO seeming to break ranks with much of corporate America right now, delivering some harsh words about President Trump's tariff.
In April 2025, the U.S. auto market hit a wall. That was the month President Trump's 25% tariff on all imported cars and auto parts officially took effect, a sweeping protectionist move aimed at pushing automakers to build more in America. But the industry didn't respond with speeches or lawsuits. Instead, it quietly froze. The biggest shift came from Germany. Audi and Volkswagen halted the delivery of at least 37,000 vehicles already en route to the U.S., leaving them stranded at ports from Texas to New Jersey. These weren't high-end custom imports. They were the mainstream models Americans drive every day: Q5s, A4s, Tiguan SUVs. And that's what made it hurt more. The pause wasn't a protest. It was a calculated business decision, a way to protect margins while waiting for policy clarity. With tariffs threatening to wipe out profits, German automakers chose to wait on the sidelines rather than gamble with volatile trade rules. They didn't release statements. They didn't argue on cable news. They simply stopped moving product, and that silence spoke louder than words. And for U.S. consumers, the impact was instant. Dealerships ran short on supply. Wait times grew, prices crept upward. It wasn't just about luxury vehicles. This was about mass-market inventory disappearing overnight. For car buyers and auto workers alike, the tariff wasn't just foreign policy. It was now a local problem sitting in the empty lot where your next car used to be. The fallout didn't stop at the docks. As news of the 25% auto tariff spread, global stock markets reacted fast. Shares of European giants Volkswagen, BMW, and Mercedes-Benz plunged 3 to 5%, signaling deep investor concern. But it wasn't just Europe that bled. U.S. automakers also took a hit, caught in the uncertainty of disrupted supply chains and shrinking inventories. Then came the deeper blow: demand.
The entire car market is so cooked. Every automaker on the planet is panicking right now because of another global supply chain shortage.
Reuters estimates that U.S. and Canadian auto sales could fall by as much as 1.8 million vehicles in 2025, not because of consumer hesitation, but because of sticker shock. With tariffs layered on top of rising material costs, the price of a new car is expected to spike by up to $12,000, according to the NYPost. That's not just a luxury tax. That's the cost of a family sedan suddenly becoming out of reach. And this isn't some gradual economic trend. This is a shock, sudden, sharp, and systemic. From factory floors in Michigan to dealership lots in Ontario, the tremors are real. Workers are being asked to take fewer shifts, buyers are holding off, and every unsold car is a reminder that what began as policy is now personal. The market isn't slowing, it's stalling. As the tariff walls rose, German automakers didn't protest, they pivoted. Volkswagen, BMW, and Mercedes quietly opened negotiations for a reciprocal trade deal, signaling willingness to expand U.S. manufacturing if it meant avoiding future penalties. It wasn't just diplomacy, it was survival. Reuters reports that executives promised to localize more production, hinting at new plants or expanded capacity on American soil. But the road ahead remains anything but smooth. BMW warned investors that the next quarter would feel the bite, even as the company tried to maintain its long-term forecast. The message was subtle but clear. Short-term turbulence is unavoidable. Behind the scenes, supply chains are being redrawn, shipments are being rerouted, and German factories' once steady pipelines for American dealerships are being scaled back, if not paused altogether. Analysts now project a 30% drop in North American auto production if tariffs persist through year-end. That's not just an economic estimate, that's jobs, wages, and local economies on the line. Dealerships across the US and Canada are already reporting thinning inventory and declining foot traffic. Some are cutting hours, others are warning of layoffs. This isn't just about re-engineering supply chains, it's about bracing for a new reality. Because in the post-tariff world, the strategy is simple: adapt fast or get left behind. When the US slammed the brakes with auto tariffs, Canada and Mexico became the detours. Rather than confront the 25% wall directly, global automakers from Germany to Japan began quietly rerouting their parts through USMCA neighbors. What used to be a seamless cross-Atlantic supply chain is now a tactical maze with Toronto and Monterey as its new crossroads. Canada in particular is emerging as the go-to tariff-proof hub. According to industry reports, manufacturers are not just shipping more components through Canadian ports, they're starting to invest there. South Korea's LG Chem is expanding battery module operations in Ontario. German suppliers are considering assembly capacity in Quebec. Even Japanese automakers are scouting logistics centers near the U.S. border. The aim: avoid U.S. customs without losing access to U.S. consumers. Meanwhile, Mexico's northern corridor is humming again, acting as a pressure release valve for suppliers once heavily tied to Detroit. Auto parts once destined for U.S. plants are now moving north to Ontario, then re-exported or sold directly to Canadian buyers. The result: North America's auto network is reshaping itself not around Detroit, but around Detroit's neighbors. In a world where tariffs set the rules, the smartest players don't resist, they reroute. The industry isn't sitting still, but it's not moving fast enough to dodge the damage. In response to the tariff shock that jolted automakers across North America, General Motors announced a $4 billion retooling initiative aimed at reshoring more of its production from Mexico and Canada back into US-based plants. The objective is clear-cut GM's import dependency from roughly 45% to 25 to 30%, according to Barron's. That's not just a supply chain tweak, it's a signal flare. One of America's biggest manufacturers is betting that the rules of global trade have changed and it's scrambling to adapt before getting left behind. But this shift is no overnight miracle. Rebuilding domestic industrial capacity is slow, painful, and expensive. Assembly lines must be redesigned from the ground up, machinery recalibrated, suppliers renegotiated, and logistics rerouted, all while keeping existing operations running. Perhaps the most daunting challenge: labor. The American manufacturing workforce, after years of offshoring and automation, is a fraction of what it once was. Training and scaling a new generation of workers to handle modern production demands won't just require time. It will demand billions more in investment, education, and political will. And there's a deeper truth hiding underneath the headlines: retrofitting old plants into new supply chains doesn't automatically translate to competitiveness. U.S. factories still face a 3x to 6x wage gap compared to overseas counterparts, plus higher regulatory costs, environmental compliance burdens, and aging infrastructure. So, while the reshoring narrative sounds good in political speeches, the real-world implementation is far messier, slower, and riddled with risk. For now, automakers like GM are navigating in limbo, stuck between a high-cost home base and a trade landscape that punishes them for relying on foreign efficiency. The retooling has begun, but it's still just scaffolding. Until the full transition is built out and proves it can compete, the industry remains vulnerable to more shocks. Whether from tariffs, regulations, or supply chain breakdowns, the hits will keep coming. And the U.S. auto sector must now decide evolve fast or get left behind. The rewrite is underway, but the ink is still wet and the ending is far from written. Tariffs were supposed to spark a manufacturing revival. Instead, they sparked shipment freezes, deal cancellations, and a quiet redirection of global trade routes. The U.S. wasn't flooded with new factories. It was left with backed-up ports and empty showrooms. America's long-standing role as the nerve center of North American auto trade is now under serious threat. Canada and Mexico, once seen as the supporting cast, are rapidly becoming the new lead actors rerouting parts investment and assembly lines through their borders. This isn't theoretical, it's logistical. Foreign automakers are no longer trying to dodge tariffs, they're designing around them. From German auto parts in Ontario to Korean batteries in Windsor, the flow of goods is reorienting itself away from the U.S. at an accelerating pace. And while Washington talks about protection, the actual production is slipping quietly out the back door. The bottom line, protectionism didn't revive American industry. It rewired it, just not in America's favor. The longer this realignment goes on, the harder it becomes to reverse. Because when trade routes change, supply chains follow. And once they leave, they rarely come back. Subscribe now because this isn't just about inflation or policy. It's a permanent shift in the geography of global industry. And for now, it's headed away from American soil.